Welcome to DWS Market Update. The NATO member states have agreed to spend 3.5% of their GDP on defense and an additional 1.5% on further security-related investments. Comparing this target with last year's defense spending, it is clear what efforts Europe needs to make. Germany will have to spend a lot of money on its defense capabilities. In addition, the federal government is planning to invest heavily in infrastructure. The federal government wants to spend over 100 billion euros on defense next year and a further 60 billion from the special fund for infrastructure. This increase alone will lead to a fiscal impulse of over 1.5%. Such figures should always be treated with some caution. However, we believe our forecast of 1.6% GDP growth for the coming year is well supported. This would put Germany back in the position of being Europe's economic powerhouse. Perhaps not the fastest train, but certainly the one with the greatest impact on other countries. We consider concerns that Germany could become a high debt country to be overdone. According to the German Council of Economic Experts calculations, the debt-to-GDP ratio should hardly rise above 80%, and in the absence of emergency situations, it should even remain well below 75%. However, the German economy should not rely only on government investments for growth. There are clear signs of an upturn in the private sector, as consumers and business are looking to the future with greater confidence. The rise in the IFO index in June is primarily due to more optimistic business expectations. Consumers also recently have become more positive about the economy and their personal income prospects. This improvement in sentiment should translate into real growth. With this constructive outlook for the German and European economy, I say goodbye until next time.